So I think you're 6x, just to kind of get back to like long-term average. And again, it's what needs to happen to rebalance the system, to de-lever the U.S. government's debt, to de-risk domestic politics, to restabilize the middle and working classes are any country's political stability. You take them out like they have been taken out over the last 30, 40 years, guess what you get? You get polarization, you get radicalization, you get instability, you get what we've got. And it's going to get worse unless you sort of let a wage spiral happen for the middle working class for a bit.
So is that 6 to 7x what you fully expect to happen?
Yeah, it's probably my base case ultimately.
So, Luke, the U.S. used to go to war and spend trillions to prevent foreign leaders from moving away from the U.S. dollar and into gold for their transactions with other countries, especially when they were selling oil, right? They took out Saddam and Gaddafi because of that. Now they seem to have done a complete 180. They're okay with foreign leaders moving to gold and away from the dollar, because when they do that, they won't have to sell their treasuries to raise the dollars to buy the oil or to settle the transaction differences. So instead of interfering, they seem to be preferring to let them trade in their own currencies and settle in gold. Will you speak into the implications of this as to the impacts on the dollar, the treasury market, and anything else of significance?
I would say that one is still to be determined. It's possible the U.S. is looking the other way, but to me, the fly in the ointment on that one is Ukraine. Ukraine is a proxy war of NATO and the U.S. against Russia, and Putin's a bad guy. He's an autocrat, blah, 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 blah. We're friends with lots of autocrats that are much worse guys. I think his real violation of the rules-based global order was what he began to do in 2008, which is buy lots of gold with his oil surpluses. And then in 2013, sold all his treasuries and bought even more gold. So I do think the U.S. will be forced to allow, or will decide finally, rightfully so, it's in their interest to allow the world and other allies like Japan to buy energy in their own currency and net settle it in gold, because that will help facilitate the shift to using gold as a neutral reserve asset to replace treasury bonds, and complete the restructuring of the global monetary system that is in the United States' interest. It's terrible for the real value of bonds, but it's really good for the United States. We can either reshore and make things here again, or we can be in the treasury export business like we were from 82 to a couple years ago. But we can't do both. So let's see how that goes. But ultimately, away from what the U.S., and importantly, there's, in my view, two factions, at least in the government within this. There is the sort of 1980 to 2022 faction of no matter what, treasury bond, dollar, nothing can be allowed to touch those things, even if we have to export on offshore all of our factories and all of our working class and all of our middle class. We'll crush Americans as long as we can keep the treasury bond whole on a real basis. There's that group of people, the Robert Rubins, the Larry Summerses of the world. And then there's what appears to be the rising faction, which started off as a tiny minority, but post-COVID, it started with Trump, and then post-COVID got much bigger. And you can see it in the comments from Biden, Jake Sullivan, National Security Director, most recently Janet Yellen, talking about, for years I said if someone wanted to send us cheap goods, we would send them a thank you note. Well, the reality was the thank you note was a U.S. Treasury bond. She said I would never, ever again send a thank you note to China. Well, that's the Treasury Secretary saying I will never, ever again send a Treasury bond to sell treasury, to settle trade. That's what she's saying. So if that's the case, then it does point to a changing view in Washington towards the system as it stood from 80 to 20 is no longer in our interest. And that's not my speculation. Biden, Yellen, Blinken, or not Blinken, but Sullivan have all explicitly said that in one form or another. So the only thing, people say, well, what's going to replace the dollar? Nothing's going to replace the dollar. Gold is replacing Treasury bonds at the FX reserve and central bank level. Our actions would seem to increase that. Will we? When will Japan in particular do it? I don't know. I think they eventually will, if for no other reason than geology is going to force them to. Oil prices are going to go up. Peak cheap oil is a geological reality in dollar terms, and so if you keep trying to pay in dollar terms, you're done. You're gonna come unhinged, and so they'll switch to a harder currency, which is to settle in gold, or settle oil in, which is gold.
So something big seems to be happening with the Japanese yen. It's been spiking from the beginning of the year. I believe it's gone from 140, and in the middle of the night it touched 160. It might have come down a little bit since then, but what is going on? It seems like that carry trade that everyone was expecting to happen to reverse did not. So what's happening with the yen? Does it foretell some things for the dollar also at some point?
One way or another, in my opinion, yeah. I just commented to someone on Twitter, like someone said, oh, the yen could go to 200. Okay. Well, if you run the 5-year correlation between the yen and versus the dollar and 10-year treasury yields, just eyeballing it. So it's not scientific, but tells you that if the yen goes at 200, I wouldn't be surprised if the 10-year treasury yields at 9%. Well, at 9% 10-year treasury yields, the U.S. government interest expense is going to be more than their receipts. And they have a word for that. That's hyperinflation. Like, that's not going to be when you have to decide to either default on your bonds or print the interest, you're done. It's over. So in my view, it's not going to be allowed to happen. It being yen getting too weak, because the weaker the yen gets, the higher the 10-year treasury goes. And ultimately that's problematic. And again, go back to rule 1. They're not going to let the treasury market dysfunction. So I think ultimately what the yen is doing will force dollar weakness, basically force us to do something, even if it's via dealing with the treasury market. I think it's possible that part of what we're seeing is an early transition toward yen buying of energy in basically the Japanese printing yen and buying energy, importing energy in those terms. I've been watching their current account with some interest, because the level of yen weakness we're seeing doesn't make sense with what their current account is doing. In other words, with oil where it is, yen where it is, their current account should be way lower. They should be running a massive deficit. As of February, they're not. So why? Because their growth is good. So presumably they're still importing oil, gas, etc., but they're not running deficits in doing so. They're not burning down dollars to do so. What? Why? Maybe it's just a lag in the data. So I'll be watching to see, because then to your prior question, the current account isn't coming unhinged. If they don't go from a surplus to a deficit in goods with the yen where it is and oil where it is, then that's a smoking gun that they're paying somebody for oil and gas in yen. And that's what's driving the yen weaker, as the greater supply of yen is offshore. And then, oh, by the way, where you'd see that is yen gold. And guess what yen gold's doing? It is like, wow. Now that's what yen oil's doing too, by the way. So I don't know. Too soon to tell. But those are sort of how I'm thinking about it.
Well, with a little bit of time that we have left, let's talk about gold and oil and stuff. So in 1955, the United States had enough gold to cover liabilities. The American gold reserves exceeded official dollars abroad by 160%. That number dropped to 25% by 71. And as of right now, it's been calculated around 7 to 8%. So getting back to like a 25% coverage, which was 1971 timeframe, somebody calculated it would need like a 3x on the gold from here.
Mhm.
So when we start to think about where gold price needs to go to look something similar to what it looked like prior to 71, leaving the gold standard, are you seeing a 3x move? Are you seeing a bigger move? What do you see for gold here?
Yeah, I've looked at it as in a similar way. The market value of U.S. official gold, right? So you just take 8,100 tons times whatever the market price is and whatever that number that gives you as a percent of the foreign held U.S. Treasury bonds divided by total value of foreign and international U.S. Treasuries. And in 71 or 72, yeah, that number was like 25%. Within a couple years, it was at 60%. In 79, 80, it was at 135%.
Wow.
Prior to 1989, which I think is important because that's when the Berlin Wall came down, the USSR broke up. Basically, the world became unipolar for a moment here in history. It was at 20% still in 1989. And then from 89 to present, basically in a straight line, went to 7. I think it got as low as 6 or 6%, something like that. So
That's amazing.
Here we are again. We've got another fiscal crisis like we had in the 70s. We've got much higher debt than we had in the 70s. We've got obviously growing geopolitical tensions, Cold War 2.0, whatever you want to call it, in a way that we haven't had in at least 50 years, because it was pretty much over by the late 80s anyway. You could kind of tell things were fading. Anyway, and yet we're at 7, maybe 8%, 7%. So to my view, just to get back to the bare minimum of the market value of U.S. official gold, assuming all the gold's all still there, which is a separate discussion, you'd have to triple the price of gold. And if you have an honest to goodness dollar crisis, which is what happened in 79, 80, when it went to 135%, you need a 20 times increase nearly in the price of gold. Now that's a gold bubble. A gold bubble, when you have 135% market value official gold relative to foreign held treasuries, that meant the United States could have, had it wanted to, sold the gold, gone out and bought every foreign treasury bond in existence, and still had 35% of its gold left over. That's a gold bubble. I would sell my gold well before 135%.
Right.
But it's at 7. Like, it probably needs to go to long-term average is around 40. So I think you're 6x, just to kind of get back to like long-term average. And again, it's what needs to happen to rebalance the system, to delever the U.S. government's debt, to de-risk domestic politics, to restabilize the middle and working classes are any country's political stability. You take them out like they have been taken out over the last 30, 40 years, guess what you get? You get polarization, you get radicalization, you get instability, you get what we've got. And it's going to get worse unless you sort of let a wage spiral happen for the middle working class for a bit.
So is that 6 to 7x what you fully expect to happen?
Yeah, it's probably my base case ultimately.
Okay.
It's probably my base case. Yeah.
So you've talked a lot about a gold revaluation, and there is a gold revaluation account. There is precedent for the gold revaluation back in 1934 when President Roosevelt, he raised it from $20 or, whatever the inverse, but from 20.67 per ounce to 35. You've talked about this as an option to get debt to GDP down from the roughly 125% down to the 50 to 70% range. How realistic is that to happen? Do you think more like just the natural forces of what needs to happen, of what we discussed, would be the revaluation, or do you actually foresee an overnight at some point revaluation where they could have the money to go grab the debt and eradicate it?
I think it's a tail risk, that option, sort of revaluing there's, if you go into the financial accounting manual for Federal Reserve banks, section 2.10, I think 2.10, basically says Treasury can go to the Fed and say revalue the gold. The increase in the price of gold would make a deposit into the Treasury general account, free and clear, no debt attached, that Yellen could spend however she wants. And the math is 261 million ounces, 4,000 per ounce is about $1 trillion per $4,000 in the price of gold. So $20,000 an ounce is $5 trillion. You could buy back a pretty good chunk of the treasury market and de-lever the balance sheet basically overnight, re-grant the Fed their independence. They could do whatever they needed to do to fight inflation. Voila. That's a tail risk to me. I think that would only be used in extremists or if there was a geopolitical thing or because otherwise I think the fiscal situation is going to force it. Like as long as rule number one holds, which is treasury market dysfunction will not be allowed, I don't see what's going to stop inflation from continuing to get higher and higher and higher and higher. And it doesn't have to get higher faster. It just has to not get lower. And as long as it doesn't get lower, I don't know what month the bond market's going to wake up and realize it's the sucker at the card table, but it isn't probably years from now. And once that happens, these things are tipping points,
Yeah. Yeah. So the natural forces, the way things are with the fiscal dominance is going to create this tidal wave higher for gold, which is going to push that 7 to 8% coverage up higher, maybe to 25, 35, 40% coverage. As this, train is moving down the tracks in this way, I would suspect that there's going to be a sentiment change from where investors view gold now to where they will begin to view gold, as it's going to become more of a prominent, it's going to take more of prominence in front of them, and especially maybe hopefully with their advisors as well. So as this sentiment shift takes place, do you think that's going to have a trickle effect down to the miners in terms of a rising tide raises all boats scenario? And this is why I'm asking this. In other FOMO events, when it has the name in it, it seems like everything spikes. So if the miner even just has gold in their name, I would suspect that if we actually do start to see a 3x, 4x, 5x, that these miners are going to explode in that way. What do you say?
It's my base case. I think part of the reason they haven't thus far has been, I don't think people believe the price of gold in terms of just the move. I think they're so beaten down. There's just, no confidence it's going to stick. I think partly there's a whole lot of money that's been siphoned off that might have gone into miners as a, gold leverage play that's sitting in Bitcoin as a leverage play on gold. The one thing I think is important that investors be aware of is that if gold is going back into the system as a monetary reserve asset, you need to hold properties in the correct jurisdictions.
That's true. Yeah.
And so the higher the price of gold goes, the more risk there is of outright grabbing in certain jurisdictions, and even in Western jurisdictions,
taxation
or something like, hey, you get the first 3,000 or 4,000 or 5,000, and everything over that goes to the government or goes to the banks. And like the reality is that would still be a really good outcome for the miners. They're still not even priced anywhere near where they should be if that was the outcome. The dividends on that alone would probably be nearly as big as a significant percentage of the current stock prices. So like that's not a bad outcome. But given my view that it's gold going back into the system as a neutral reserve monetary asset again, it is something investors need to be aware of, which is to say, like, if you want to own gold, own gold. Like, not saying don't own miners, but don't say, oh, gold's going to go up a lot, but I'm not going to own any gold. I'm going to own all miners and have leverage, because you would hate to be wrong for the right reason. Similarly, own gold. Don't, every party that is between you and your metal is a potential point of failure. And look, we saw what happened in 2008 with the credit default swaps. When it became clear that AIG had failed, and that if they didn't perform on those credit default swaps, the banks were going to fail. They got paid at par. And why I bring this up is if there are and I don't know if there aren't anymore. I don't know the positions, whatever. If the too big to fail banks are net short gold in some sort of geopolitical or market event like this, and you're long gold through the banks, I would bet dollars to donuts that retail will get cash settled, and the banks will hold the bullion, and they will get cash settled at Friday's close to keep the banks whole. We saw this, just the reverse exercise in 08. So caveat emptor, if you want to own gold, not
great point.
So that's the only thing I would say. That's the only thing I would say to people on that.
Okay, that's a great point. Yeah, so I do have a copper question here. Copper's up more than 25% over the last 6 months. As of this morning, it was around $4.60 a pound, I think. Output keeps falling due to lower quality ore. No new huge mines have come online in quite some time. China's buying up copper at a record pace. Supply is tight. Demand is strong. Luke, what is copper telling you, and what are you expecting for copper over the next 12 to 24 months?
I think copper goes higher. I think what it's telling us is peak cheap copper is an issue right along peak cheap oil. And unlike oil, where you can at least make a case, I think it's largely hopium, but you can make a case that maybe oil demand will slow in the next 5 or 8 years. Like, they're literally every day on any business and financial, like, all they do is tell me about climate change and electrification and nuclear and like all this stuff doesn't work without copper.
Right.
Like we had the and it's so fundamental. I found this hilarious article a few weeks back where the government had one of their, I don't know, the Inflation Reduction Act contracts or whatever, and they forgot to add the cost of the copper wiring. Like they didn't allocate for that, so they had to go back and reallocate to that. Like, so to me, you've got very strong demand, peak cheap supply. You know, it's a very bullish setup, I think. Yeah. Especially when we go back to the monetary side, right? Where, rule number 1, no dysfunction in the treasury market. So like to get a slowdown, you need dysfunction in the treasury market, crisis, slowdown. It's not going to happen.
Yeah. So you've talked about oil a couple of times here. So oil is more expensive to produce today, despite the increasing supply. There's been a massive decrease in the strategic petroleum reserve over the last couple of years. OPEC has reduced production over the last 12 months. Luke, there's some analysts that are saying shale production has peaked. What should we be expecting in terms of oil supply, oil costs, and its impact on the economy moving forward over the next 12 to 24 months?
I think all else equal, oil goes higher. I saw a chart the other day, it blew my mind. I kind of knew it, but still to see it blew my mind. Global oil exports on net are flat since 2005. 2005.
Wow.
Staggering, right? So, and that includes, 80 to 90% of global oil production growth over the last 10 years, according to Go Rosen, has been shale. Shale appears to be peaking in numerous basins. I just posted something on Twitter today highlighting that the Dallas Fed quarterly survey of energy in the Permian, the break-even price, according to survey respondents in the Permian, which is, if not one of the single biggest oil producing region in the world, it is definitely the biggest U.S. shale basin. It is definitely the slowest declining U.S. shale basin. And these Permian respondents, quarter on quarter, the break-even price rose by 25 to 40%. Wow. Whoa, after being largely flat since 2018. So now they need $60 to $70 to break even. Tells me prices ain't going below 60, 70 for any period of time, which is hilarious because you hear people say, we're going to cap the Russians at 60. Good luck.
Good luck.
Good luck. It'll be, here's my barrel of oil at $60. It'll be like, an imaginary friend. It won't exist. So when I say all
Sounds
else equal, yeah, I mean this is a forcing function to treasury dysfunction, right? Like this is inflationary. So now you're talking about, treasury markets aren't allowed to dysfunction, which means we'll have whatever liquidity we need to keep them functioning. But the bottleneck is copper. The bottleneck is oil. The prices of these things aren't going to stop going up. They can't, they can print the money to keep the treasury market functioning nominally, but they can't change the geology of copper and of oil.
right. Right.
That's it.
Sounds very similar to the setup that was in uranium just 18 months ago or so, where, if as Rick Rule would say, if the price keeps going any lower, the lights are going to go out. So that's just not going to happen.
Yep.
All right. Well, before we wrap up here and I ask Luke our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every expert interview that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold, just as Luke was talking about earlier. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive this free gift on us. Also, if you've enjoyed this conversation with Luke as much as I have, please let him know. Hit the like and subscribe button and leave a comment below the video. Luke, in wrapping up our discussion, I've got a two-part final question for you. In light of all that we've discussed, the debt, the geopolitical, the macro backdrop as it is, how do you recommend positioning for the investor tuning in? What do you like? What do you want to be in? What do you want to stay away from? And which I think I've got a pretty good point on, at least one. And what countries have some demographics, resources, and labor markets that you believe are going to boom over the next 20 years the way China did over the previous 20?
Well, my favorite assets: gold, Bitcoin, U.S. industrial stocks, electrical infrastructure, exposed equities. Those are my favorite positions. I still have a pretty decent sized cash position just for the optionality. You get paid 5 and change percent to wait, because I do think you'll have some of the volatility around some of the issues we discussed. I think to me, I think over the course of the cycle, mid to long-term bonds have to be certificates of confiscation. I don't see any reason to own them long-term. You can trade them here or there. Obviously, there have been a couple trading opportunities up and down over the last 6 months. If people want to do that, like as one of my dear friends on one of my best friends on Wall Street says that, bonds are a blood sport. Like you want to go in there and, mix it up. Great. But to me, it's not how I like to spend my time. For countries with the demographics issue, I think, is a interesting one, because I could go either way with demographics, right? So like we've got, who's got great demographics? The Middle East. Middle East has some of the best demographics in the world, but what they don't have is political stability. And in some cases, those demographic growth leads to political instability. And I think we're seeing a little bit of that here in the United States right now, which is to say we have the best demographic. The Chinese demographics are terrible. Russia's demographics are terrible. Japan's demographics are terrible. South Korea's demographics are terrible. And you know what? They don't have widespread, they don't have people protesting across campuses, and they don't have sort of the political radicalism that we're increasingly having here, et cetera. So to me, the demographic issue somewhat hinges back on your prior point around AI, right? Like if AI and automation do what some people think they will, and then I think a lot of people looking at the demographic issues are going to have to turn their viewpoints on their head, which is to say, if AI and automation let's just say, wipe out 20% of white collar jobs. Just after, now, what are you going to want? You're going to want a shrinking population, and you're going to want it to be old, because old people don't protest and riot. Whereas, so all of a sudden, China, Japan, all these countries with terrible demographics are going to be the most politically stable countries. Whereas places where you have imported a lot of young people and then left them with no economic opportunity, like the West, and AI and automation took away a lot of that economic opportunity further, you're going to have touched off a match and thrown it into a nitroglycerin plant in terms of the political stability of those places. So, to be determined. I don't know how this will go. I think my base case on automation and AI is it will be like the internet, which is revolutionary, but longer than currently sort of being discounted. So let's see. So for me,
do you like India?
I prefer, my favorite emerging market is the American Rust Belt. Like, I look around the world and I say, okay, where do I have a history of rule of law? Where do I have a population that is at least relatively close to carrying capacity in food, water, energy, and a big, we've got a pretty good research and university base right here for grads and education, So to me, my favorite emerging market remains the sort of the American Rust Belt, broadly defined, sort of, Minnesota down to, Georgia, out to, a little bit beyond, the Mississippi River. So, Kansas City, Denver, what have you. That's my favorite emerging market. In part because if the monetary system changes we're seeing and describing continue to unfold, the bottom 50% gains on the top 1% for a decade after 40 years of losing to the top 1%, that part of the country is going to boom.
Yeah. Fascinating. Luke, thank you for coming on to Metals and Miners, for being so generous with your time, your analysis, your ideas. It's been awesome to spend this time with you. Would you please share with the viewers any final thoughts that you want to leave them with, and where they can learn more about your work and how they can connect with you?
Yeah, I would say, my final thought is keep your leverage very conservative and only on productive assets that are cash flowing more than your interest payment. I think that's going to be really important. In terms of where to find me, at Luke Gromen on X and FFTT-LLC.com for more information about our institutional and mass market research products.
Wonderful. Thank you. I look forward to having you back on, Luke. Thank you for being here with us, and everybody else, thank you for watching.
Thanks for having me on.
And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold, just as Luke was talking about earlier. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us.